Wall Street Week with Louis Rukeyser. Brought to you by public television stations and by Hilton Hotels, America's business address, and its subsidiary Conrad International Hotels. Competition makes American business excel. Prudential Bates Securities, the investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology, computer-based systems solutions to the complex problems of business, government, and defense. Produced Friday, June 20. Our panelists are Frank Cappiello, Monty Gordon, and Carter Randall. Tonight's special guest is Stephen Leuthold, Chairman, the Leuthold Group.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, what can I say, dear, after I've said I'm sorry and I'm back? This tradition of the market going to pieces every time I go on vacation is getting a little too reliable for comfort. Sure enough, this time again, the very day after I announced that I was taking one lousy week off, the Dow Jones Industrial Average plummeted 46 points, their worst single-day point loss ever. Talk about a bunch of weaklings who are unable to stand on their own 2 feet. Indeed, last week as a whole was a loser, as were the first 4 days of this week. So I heroically came roaring back on the scene on your behalf today, and the market dutifully responded with a 24-point gain, bringing it to its best level since my departure. You're very welcome, and no, I don't know why it always seems to work that way either. But we've got to admit, it sure is spooky. Graham and Dodd knows there were no more logical reasons for the market's weird and erratic behavior. The economy remained in its rut, weakly progressing, but still offering more the promise than the reality of a second-half pickup. The government revised downward its estimate of first-quarter growth. Personal income faltered, and housing starts took their worst dip in a year, hurt by a slowdown in apartment building. But as usual, there were also brighter notes in this mixed and mixed-up economy. Factory shipments rose a notch, and so did the average pay of factory workers, while the real heroes and heroines of this 4-year recovery, the buoyant American consumers, confounded the gloomsters once again by increasing their spending. As for inflation, the headline news was that the longest, sharpest consumer price plunge in almost 4 decades ended last month. But May's 0.2 of a point increase after 3 months of actual price declines was scarcely terrifying. Indeed, the temperature of the American economy, as the summer of 1986 begins, is clearly neither torrid nor frigid. It's just plain lukewarm. We tonight will undertake the more difficult task of assessing where that economy and its financial markets are heading, in the company of a guest who thinks it may be time to start looking for the exits. But first, let's check out those frisky boys of summer and see how the mice of Wall Street played this week until the cat was no longer away. And as the Dow Jones Industrial Average indicates, it was nearly all downhill until Friday, one of those so-called triple witching hours that occur every 3 months, when stock index futures, options on those futures, and options on individual stocks all expire at the same time. On the last such day in March, the Dow skidded 36 points. Today it moved sharply in the opposite direction, giving the Dow a gain for the week of just over 5 points to 1879.54, within 7 points of the record it set 2 weeks ago on the day I was last with you. Also little change for the week, and again knocking at the doors of their own records, were all our broader market indexes. As for our elves, this is the last week they can get away with claiming spring fever for their technical market index, which slipped a notch to a mildly bearish -2. Winner of the week was the U.S. dollar, which increased in value against every major foreign currency. Loser of the week was gold, which traded at its lowest levels in 2.5 months, as market vultures expressed their disappointment that large-scale violence in South Africa had failed to materialize. Meanwhile, back here in the land of the free, the market was churning out enough junk to commemorate the Statue of Liberty's centennial to make an unbroken line of replicas from here to Zambia. If you don't hurry, you may miss your chance to buy a $10 muffin tin reproducing the head and torch, a $20 tin of Statue of Liberty pretzels, or worst of all, your very own imported Statue of Liberty-shaped pasta. Carter Randall, you're at liberty to tell us what you think of this market.
Lou, I'm not bearish, but I've been cautious for quite some time. I just, a sluggish economy, I don't see earnings coming back. And this market has been interest rate driven, but we need the earnings, and I don't see them yet.
Well, everybody's predicting well, everybody, but some people are predicting a second half pickup. Are you in that camp?
Yes, I see a second half pickup. I think the low interest rates of the first half are going to spur the economy a little bit, but I think it takes more than that. And my problem is there's no thesis here. There's no leadership in the stock market. I can't look at 3 or 4 groups and say, boy, they're just about to move. You've got to be very selective in this market.
Time to take some profit, raise some cash?
No, still holding some powder dry. I'm not a seller yet. I think there's more on the upside of this market, but I'd be cautious, and as the market moves up, I might pare back a little bit.
What do you make of the interest rate picture now?
There is absolutely no reason for interest rates to go up, either political or economic, and there are plenty of reasons for interest rates to keep on going down, and that's my best bet.
You know that, and I know that. Do the interest rates know that?
They will find out.
Okay. Frank Capio, do you agree with all that?
Well, first of all, I know we're going to buy the Liberty pasta.
For you, we have a very special price. Same when we offer all that at Tanner's in trouble.
The pluses still outweigh the minuses, Lou, but the pluses are getting thinner and thinner. The action of the market, higher highs over the past month or so, and higher lows is what you would expect. We've had the over-the-counter market now, very dynamic, new issues are starting to pop. That's not necessarily a sign of the top. It means we're reaching for the top. And the short interest, which recently came out, which isn't what it used to be as a bullish indicator, is still a fairly
Why don't you explain
bullish.
Short interest for those people who are not dwarfs?
Well, that's someone who sold stock short, sold stock he doesn't own, in the hope of buying it back later.
Well, a lot of people have done that.
Yes, a lot. Record levels. We've never had such a high short interest, so that's positive. But the negatives are starting to grow.
They're going to be wrong, all these people who sold.
Yes, I think so.
I just want to explain what this means. This is based on contempt for the masses. Is that right? When more people are pessimistic, you become more optimistic. Is that right?
Yeah, but they're not all experts, though.
I see.
Do you want me to get to the minuses?
Please do.
Okay. Well, I guess the biggest minus, I think, is the obscuring of the fact that we still have this enormous federal deficit that's looming up that's going to have to be taken care of, and I think the tax bill obscures that. And I guess the other problem is lack of leadership. IBM, GM, and Merrill Lynch, which used to be 3 leaders, have all deteriorated, and we're looking for a leader.
Where do you think we're going to find it, if anywhere?
Well, I think it could be a big food stock, but the food stocks have already had their run, so it's hard to find.
Let's get some food for thought from Monty Gordon. Monty, you were cautious for a long time, then the steamroller took you along with it. Are you ready to be cautious again?
Oh, I still am cautious. I think the market is demonstrating a behavioral pattern which gives every evidence of someone who's in midlife crisis. Everything is coming into question. What you thought was going to happen, the second half was going to be much better, the interest rates were going to go down, the Fed was going to stay loose, everything was going to happen. All of a sudden it's being questioned. It's not only being questioned in terms of what it was in the past, but what's in the future. So what the market is doing now is, for the first time, it's really beginning to wonder not just whether there will be a second half recovery of significance, but why it hasn't come to this point, which then serves to highlight, as Frank mentioned, a lot of the problems that are around. One of them being that a large segment of this economy is in a recession. And that's a simple fact. The energy area, the mining and industrial area, the agricultural sector, and what you're looking at in the tremendous performance of the service sector, if you look at it from the underside, may well be a tremendous amount of movement which is barely succeeding from holding us back from a significant recession. In other words, we're trying to pull the industrial and depressed areas out of their condition.
So the next question is, do the service sectors now falter, or does the industrial sector come on?
Well, that's the question I can't answer. But one thing is for sure, if you're
not?
if you're going to service something, if you're going to be a service industry, you better have something to service. So the effort has got to be to reinvigorate the industrial sector. And I think the market is questioning whether that
This
can
economy cannot endure half going forward, half going backwards.
happen. Very true.
In any event, gentlemen, it is time now to make sure that our viewers get everything they deserve, plus at least 20% more. Carter Randall, William Ulrich of Evanston, Illinois, would like you to explain the corporate phenomenon known as the golden parachute, in which top executives receive huge settlements when they leave their companies. How is it even possible, much less legal, he asks, for so-called trusted company officers to steal such large amounts of money? Would it be any different if an ex-president of the United States took a suitcase over to the government printing office and filled it full of nice, fresh $100 bills?
It's not quite so simple as that. There are pros and cons to the golden parachute. Companies give their executives big pension awards, lifetime incomes, to encourage the executives to stay with them, particularly in times of takeover and so on. And so there is a plus to it to maintain the management. But of course the minus is that sometimes they're exorbitant, and it's overdone. It's not necessarily the benefit of the stockholder, but it's not quite like stealing.
Relieved to hear it. Frank Capriello, John Bruger of Hightstown, New Jersey, who writes, "Thank God it's Friday and Rukeyser is back," a kind sentiment, which I indeed thank him, is concerned about the proposed tax change that would eliminate the present lower rate on long-term capital gains. He has what he describes as some hefty long-term gains that he feels he had better take this year before the law changes. But he would still like to own those stocks. He'd like you to explain to him the rules for selling stock and then buying back the same number of shares without running into trouble with the IRS.
Okay, well, the rule that he's talking about is an IRS rule called the wash sales rule, which says that if you sell a stock at a loss, then you cannot buy it back 30 days before you sell it or 30 days after. Otherwise, the loss is disallowed. But we're not talking about a loss here. We're talking about a profit. So he does not come under this. Say he bought the stock at 10, the stock is now 20, he can sell it at 20 and buy it back at 20 or 20 and a fraction. No problem. What he should be thinking about, though, is that he has a tax liability here. So sooner or later he's going to have to pay a capital gains tax, and maybe he shouldn't buy the same amount of shares back again. He should save something for the taxable impact. Okay.
Monty Gordon, Mort Basner of Penn Valley, Pennsylvania, would like your appraisal of the outlook for stocks of cosmetics manufacturers.
Actually, Lou, the outlook for the cosmetic manufacturers is not bad. It's an industry that is growing at a pretty good rate. It's selling at little reasonable multiples at this particular point. They will benefit to a certain extent from reduced raw material costs and things of that nature. But it is an industry where the growth has been recognized, so the multiples are reasonable relative to the Standard & Poor's, but certainly not exceptionally attractive. I would say that it's a kind of an industry that you look out into the longer term, but there's increased competitive pressures in here. Three of the companies that probably are attractive at this point: one is Gillette, another is Noxell, and another would be Tam Brands.
All righty. Now, if your investments have been taking a powder, there's no need to blush. Let's kiss and make up. For answers that might make more than a cosmetic difference, my pretty, eyeline your money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take a look at some of the historical measurements he uses to answer a worrisome question that he thinks we all ought to be asking these days. Are stocks too high? In search of an answer, he has checked figures dating all the way back to 1929, during which period he found, for example, that the dividend yield on common stocks has a historical median of just over 4%. Today's investor gets a lower yield, less than 3%, and he thinks that's a danger sign. He finds a further hint of overvaluation in price-earnings ratios, which compare a stock's price with its earnings over the last 12 months. The median has been 14.5 times earnings. Today, you have to pay up to nearly 18 times earnings. He draws the same worried conclusion when he goes by the book, comparing a stock's price to its book or hard net asset value. Historically, the median selling price for stocks has been less than 1.5 times their book value. Today's price is higher, more than twice book value. Finally, he looks at the competition from bonds. The median yield on quality bonds since 1929 has been just under 5%. While good corporate bonds are today paying in the 9% range. In short, he thinks it's clear that stocks are no longer cheap. But does that mean they are too high? For some thoughts on that, let's go over now and meet tonight's special guest, Stephen C. Leuthold. Steve, welcome back.
Thank you.
Stephen Leuthold, who tonight makes his third appearance as my guest, has the rare talent of being superb with numbers while also retaining a commendable familiarity with the English language. He practices that talent as head of the Leuthold Group in Minneapolis, from where his analyses are closely followed by big-ticket institutional investors across the country. Steve, how bearish are you right now?
Well, I'm not exactly bearish. I'm saying that the market, by a lot of our standards, our intrinsic value benchmarks, is no longer cheap. And so we've got to be very, very cautious. And I guess some of our other work tends to demonstrate the momentum is lagging. And so I am becoming cautious, and I guess if you want to call that bearish, call it bearish.
Well, I would never characterize you, Steve, except in the most glowing terms. Caution is always appropriate when you're dealing with your own money. But there are only three things you can do. You can buy, you can hold, you can sell. What are you recommending?
Or you can cover yourself with some puts. There are some other ways we can get defensive. But we have...
You're suggesting people take an insurance policy by buying put options on stocks they hold.
puts or XMI puts, right.
Or XMI being index options on the whole broad range of stocks.
Right. But it is, I think it is time to very seriously consider locking in, taking some gains, building some cash, or taking out some insurance. And the market certainly could go higher. I mean, we could run another 10%. But there aren't very many of us that ever get the tops, and we are in vulnerable territory.
You correctly emphasize selectivity. Is there any area in which you would be putting new money these days?
Well, we like the utility cash cows. These are utilities where they're generating far more money, far more cash than they're investing in new plant and equipment. And they offer a pretty good yield, 6–7% in many cases.
Do you know any that have names?
Oh, some like maybe Kentucky Utilities is, I think, a good example. Primark is another good example. There are some that have had very big moves because some people view these as being potential buyout or restructuring candidates. But I think it's a way to play the market on a continuing basis, even today, conservatively.
Though you are extremely cautious, to use your word, on the stock market, you somewhat unusually are bullish on the bond market. Is that correct?
That's right.
Now, most people say that one of the problems with the stock market is that interest rates may no longer be going down.
Mm-hmm.
Why are you positive on bonds while at least cautious on stocks?
Well, it seems to me that the lockstep relationship of recent years, in fact, for the last 15 years, with the bond market and the stock market pretty much moving together, we may be just about at the end of that relationship. And we may be going back to the more basic relationship between the stock market and the bond market that we saw prior to 1966, where typically when the bond market was going down, the stock market was going up.
Because the bond market was going up in poorer times economically, and the stock market was going up when earnings were rising.
That's right.
Is that why the one area that you mentioned positively in stocks, the utilities area, is one that is key to interest rates?
Well, we think that's one of the factors that favors utilities. Value, dividends, interest rates, they're becoming, in Wall Street, they're becoming fair game also for restructuring and perhaps some buyouts. So I think it's a multifaceted play, and it's fairly conservative.
Where would you sell stocks next week?
Well, I think it's maybe a lot of high-priced food stocks, a lot of those slow growers with fancy multiples, and...
I think I may have a buyer for you. Frank Cappiello suggested that might be the next area to go up. Why do you disagree?
Well, it seems to me that if we look at the relative multiples of those stocks compared to their history, they're selling at very, very fat premiums. They've had big moves. They've been institutional favorites. And I think maybe the merger and acquisition phase may be slowing down to some degree here in coming weeks, coming months, coming years.
Let me turn you over to some members of the Rukeyser Group, starting with Carter Randall.
Thank you, Lou. Steve, if you're, quote, bearish, unquote, on the stock market...
Now, Carter, I didn't say I was bearish.
I said, quote.
Oh.
You must be worried about the outlook for the economy of the nation. You must think perhaps, because it's a leading economic indicator, you must think perhaps we're in for an economic downturn, do you?
Well, not really. My concern comes because of those tables that were run earlier, where we're seeing stocks selling at 2 times book, and we're seeing us at hefty multiple levels, and we're seeing very low yields on common stocks, below 3%. So I get very cautious when I see that type of thing. But the market can stay at these still high levels if you get one thing happening, and that's a surge in earnings and dividends.
Are you looking for a weak economy?
I don't know, and that's why I'm cautious, because I don't know if we're going to get it or not, but I think it's time to maybe take some defensive measures while you wait and see.
Steve, regarding a scenario on bonds, food stocks would be a very defensive measure to take with a low inflation factor. But that's not my question. My question really relates to the 1920s.
That was your angry rebuttal.
In a 1920s market is being used as a proxy for this market. People are saying, here we are like the 1920s, 1922, 1923. We've got a big market ahead of us. Do you agree with that?
I do agree with that. What I'm talking about, I'm not talking about the end of this big secular bull market. That is that market that started in '74 and has continued on. I'm just looking for the advent of maybe some pretty good, what we might call a cyclical bear market in our jargon. A decline of only maybe 25%, something like that.
Says that with such aplomb, doesn't he? Let's come up a little bit further, closer to what's happening now. One of the big developments that's underway that you hear and read about, and of course a lot of people are studying, is the tax reform bill.
Right.
What investment strategy, if any, of you developing with regard to the tax reform bill?
Well, first we have to see it passed, I guess, but...
Oh, you will.
Okay. And close to its current form coming out of the Senate. And I would say that one of the most bullish implications of that is for fixed income securities, for bonds. I think also there are some negative implications, certainly for heavy industry, although we haven't seen heavy industry make a lot of use of the investment tax credits anyway. They haven't gone out and bought a whole lot of new plant and equipment lately.
If you are positive on bonds, which bonds would you buy?
The unfortunate part is you don't have very many choices if your feelings are similar to mine, which means I think long-term bond rates are going to go considerably lower over the next 4 years, maybe as low as 5.5%. And government bonds are the only place that you can lock up call protection, that is, keep the lender from paying you off ahead of time. And so your only choice really is the government bond market, if you feel like I do.
And would you buy bonds 30 years out, 20 years out, 10 years out?
Well, we focus right now on about 20-year bonds. The 30-year bonds, there's a pretty large yield differential between the 20-year and the 30 years. And I also think that if someone is quite aggressive, 20-year zeros make a lot of sense to me.
Zero coupon bonds.
Zero coupon bonds.
Steve, you told your clients this month that your major trend index had tipped to the negative side, that it appears the stock market is about to enter a cyclical bearish phase. You talked to the popular averages falling 24 to 30%. But you also confessed that the 5 signals registered during the last 12 years were, and I quote, not so reliable.
That's
what
right.
might happen to change your view to a more positive one on the stock market?
Well, I think what would happen would be for this index that has about 125 components to shift back to the positive side, and I'd be delighted to shift back.
What are some of the important changes that we would be able to see?
Well, one area is some of the things that we reviewed at the beginning of the show, the intrinsic value work. That's one big category, and they're quite strong on the negative side right now because by historic standards we're fairly high.
So either earnings and dividends have to improve, for example, or stock prices have to come down.
That's right. That's right. Economic and monetary, that whole package is still positive looking in our work. Supply-demand factors are right now shifting toward the negative side. Our attitudinal work, which is the attitude of different types of investors, is also negative. But the technical momentum breadth work still remains positive, although it's deteriorating. But when we add it all together, we come up with a negative balance.
Thanks very much, Steve Leuthold, for your usual Fascinating discussion of a market in which you're not bearish, think it may just fall 25%. Thanks to our panelists, and I hope you'll be back with us again next week. Then I'm going to be talking with one of the leading stock pickers in Wall Street. He's Suresh Burid, and he'll be telling us which issues he thinks will be sizzling this summer. It should be a very hot time in the old studio next week. So till then, my friends, be sure and stay cool. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by public television stations and by Hilton Hotels, America's business address, and its subsidiary Conrad International Hotels. Competition makes American business excel. Prudential Bache Securities, the investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology, computer-based systems solutions to the complex problems of business, government, and defense. For a printed transcript of this program, send $3 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. That's $3 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. Maryland residents, please add 15 cents sales tax. Wall Street Week transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week is produced by Maryland Public Television, which is solely responsible for its content.